Today's episode is brought to you by Raisin UK, the free online savings platform with savings accounts from FSCS-protected banks and building societies. Welcome to Many Happy Returns, where we aim to make you a better investor. I'm Roman.
And I'm Michael.
Liz Truss's mini-budget has become a bogeyman for all fiscal policy, and once again, gilt yields rose following the autumn budget as markets absorbed sharp rises in investment, taxes and borrowing.
Do we really need to be scared of the bond vigilantes? And in today's dumb question of the week, does public investment crowd out or crowd in private sector activity? Okay, let's get into it. So last week we had the autumn budget, Labour's first budget in 14 years, and it was a big budget. Big increases in spending, large tax rises, and a lot of government borrowing penciled in for the coming Parliament. While the Chancellor was speaking, all seemed pretty calm in markets, but then, in the days that followed, gilt yields did the thing everyone doesn't want them to do and started to creep upwards. And we saw headlines which referenced bond vigilantes. Here they are, they've come to get us. But Romin, what is a bond vigilante?
Well, the idea is that there are bond investors who, when they see a budget come along and it has policies which they think will hurt their investment, they sell their government bonds, and they do it in large size. So presumably these are institutional investors who want to kind of punish the government, supposedly, for their policies.
Inevitably, we got a million headlines about the government spooking the markets on Halloween. But I'm a little bit skeptical of these bond vigilantes. Are they a real thing? Is this a coordinated action by some sort of shadowy cabal of bond market investors?
Well, I think if people want conspiracy theories, this is the wrong podcast, so I'd tune out right now. But look, I think that's unlikely. I think one of the things that people really should bear in mind is that bond investors will always act in their own interests because that's their job. If they're a fund manager and they think that yields are going to rise, well, they're going to sell some of their gilts because they don't want to take that hit or shorten duration, for example. So really, I wouldn't blame the bond investors for doing what's rational for bond investors to do, which is acting in their own interest. It's kind of like blaming a lion if you stick your head into its jaws. You know, it's going to eat you. There's no question. So I don't think we should blame bond investors. And I don't think there's a cabal of bond investors going around trying to punish governments. It's just them doing a rational thing.
Do you think Rachel Reeves did stick her head into the metaphorical lion's jaws, though? I think she would reject that analogy. She would say the UK needs investment, and that means, at least in the short term, borrowing more.
I'd say it's kind of the opposite. I feel as if every government now is going to be terrified of lions and simply shirking any kind of increase in spending because they're worried that they're going to get a repeat of what Kwarteng and Truss managed. But I think that's the wrong message to take home. And I think it's going to actually be detrimental to growth because people will be too scared to do something really radical in order to stimulate growth.
Interesting. Because I think the mini budget that Liz Truss had, where we saw a really, really sharp rise in gilt yields and a kind of doom loop which the Bank of England had to save us from by stepping into the market and buying gilts, that wasn't really an episode of bond vigilantism, if you want to put it like that. It was more the case that she stumbled into a strange market where British pension funds had done this liability matching thing, and a rise in interest rates meant they had to sell gilts mechanically. And it created this kind of death spiral. Like, she lit the match, but the explosion was not really the free market.
And in a sense, the explosion had already happened. If you look at UK gilt yields leading up to that budget, they'd soared. And what that mini budget did was simply to make them soar a little bit more, actually quite a lot more, because of this LDI problem, but also because of the rate of increase of gilt yields, because I think that budget was so poorly telegraphed and so poorly designed. Remember, this was a time of high inflation. There were unfunded tax cuts, which are inflationary, of course. And they didn't have any input from the OBR to give some kind of veracity to the numbers. So I think part of the problem was that some people sold bonds initially very rapidly, and then it got a second wind, the sell-off, because of the LDI problems and the fact that people had margin calls and they had to sell gilts to fund those, and then we got this downward spiral.
Thankfully, that structure of the pension market is no longer there. So you shouldn't get that doom loop dynamic, at least from that corner of the market. But weirdly, I think the mini budget from Liz Truss is kind of a blessing and a curse for chancellors nowadays. It's a curse in that bond markets are watching UK budgets very closely to see how much they're going to borrow. But also it's a blessing because even when we get a bit of a negative reaction like this time, everyone goes, well, it's not as bad as Liz Truss the lettuce.
And if we look at the yield change for this latest sell-off, it isn't anywhere near as bad as it was for the Kwarteng Truss budget. So, for example, if we look at the 10-year Gilt and we track yields 20 days before and after the budget, there was a 1.6 percentage point increase after the Kwarteng budget. Now, it's early days. We're only about a week into this. And the UK 10-year is currently about 25 basis points higher. So 0.25 percentage points, in other words.
Is that the way to measure it? Because I've seen some people saying yields now on the 10-year are higher than they were at the time of Liz Truss. Surely this is worse. But like you say, it's the scale of the reaction, isn't it? Rates are higher now across the world.
That's right. So that's not a UK thing. That's a global phenomenon.
Now, I have seen some people say that this time round, it's all due to global effects. There's the US election and yields have pushed higher in the US and across the world. But that's not true either. It's somewhere in the middle, right? If you look at the spread of gilts to bunds, this is German government bonds, they are at their highest now since the Liz Truss mini budget. The UK's borrowing costs relative to the rest of the world have increased.
Now, what's kind of interesting, if you look at that spread, is that before that budget, it was around 100 basis points or less. Then we got the Liz Truss budget, it spiked above 200 basis points. Briefly, it dipped down, but then from May onwards, it spiked back up to pretty much where it was previously. And it's been hovering at around 150 to 200 basis points ever since. So I think this has only been a slight increase to about 210 basis points from about 160 before. So this seems to be a new thing, which is that the UK treads at a spread to Germany. And it's a fairly large spread compared to history.
And weirdly, I think it's not all about the UK. The German economy has real problems right now and some deflationary dynamics which would depress their interest rates. So it's kind of like the German rates going down, really, while the UK rates going up. But I think it's fair to say the Treasury was a little bit surprised that the market did react negatively. And I say that because Rachel Reeves made an unscheduled appearance on Bloomberg TV, which is unusual for a chancellor. And she reinforced that her number one commitment, I quote, is economic and fiscal stability. They maybe were a little worried that they rushed the chancellor in front of the cameras.
Yeah, I think it's good that she did that because it's clear that they have to say something to keep yields down.
What they didn't say is, there's more to come, like Kwasi Kwarteng said the day after the mini budget.
Right. Yeah, they didn't pour fuel on the fire. And they've been very clear in their messaging all through, right? So I don't think there were many surprises. So I'm surprised, actually, that the yield increase was that large, given the size of the spending increase and how careful they've been not to let debt get to a huge level relative to GDP. So they've still got these really strong fiscal rules.
Well, let's talk through that, because, Robin, this might be a rare case where you and I disagree.
Oh.
Because I watched your YouTube reaction video to the budget, which was really good. And to sort of misquote you slightly, you said something like, Rachel Reeves didn't do enough, right? She should have borrowed more. The markets are relatively tame in reaction. This shows she could have gone further and invested more. But when I look at the figures, she is investing quite a lot more than was planned previously. So spending is budgeted to increase by £70 billion annually. And the stat that blows my mind is that if you look at total public spending, so this includes the day-to-day expenditure and the investment, by the end of this parliament, that is forecast to be around 44% of GDP. If you compare that to before the pandemic, that's 5 percentage points higher. That's a massive increase in the size of the state as a share of the economy.
But if you look at other huge spending increases in the past, if you look at what's really required to take a country which is effectively not growing, which is pretty much where we are, growth has been so poor. And if you look at wage growth over the last decade, again, there's been hardly any real wage growth. Well, it takes a really big kick to turn that around. And okay, this is a big budget, but I think it could have been bigger. And market response, in my opinion, is that it is fairly muted. I think they could have gone further in terms of debt issuance. But look, it is positive, and I think the fact that they actually care about growth and they've made a huge spending increase in order to start it is a positive. Don't get me wrong. I just think in terms of degree, they could have gone even further.
But could they? So you said they changed the fiscal rules, which is true. So the first fiscal rule says day-to-day spending has to be met by tax revenues. That's kind of uncontroversial. But then the big change was to the second fiscal rule, where Rachel Reeves adopted a different measure of public debt. So it moved from just a plain measure of public sector net debt less the Bank of England liabilities to something called PSNUFL, which is public sector net financial liabilities, which basically allows you to offset some of the government's future revenue from financial assets, things like student loans, against the debt that they're taking out. And this is a looser fiscal rule. This allows you to borrow more. It flatters the public finances because you're looking at some of the assets and not just the debt. But even with this looser rule, the headroom on it, according to the OBR, is almost non-existent. So just 16 billion by the end of the forecast period. So to say she could have borrowed more, well, yes, she could. Of course she could. But she'd have had to have an even looser fiscal rule to be allowed to do that. And I think that would have been a risk.
But that's what I think she should have done. I think she should have said, look, this 5-year target is bullshit, because if you want your country to grow, thinking over 5-year terms is, I think, unrealistic. I think you should have an even longer term view. And of course, if you're a politician, you think in 5-year chunks because you're not going to get re-elected.
Yeah.
So that was the worry, I think.
10-year PSNUFL for you?
Yeah, I think 10-year PSNUFL would be much better than 5.
I actually think you might be onto something there. But I can see why they do it in 5-year chunks. And they're actually going to start reducing it to a 3-year target because that is the period over which a government does a detailed budget. And you get this weird fiction, really, in budgets where they front load everything. All the spending gets front loaded. So it looks like the departments have got lots of money over the next 3 years. But then for the 2 years at the end of the forecast period, where they don't have to like line by line say what they're going to spend, they go, it's going to be way less those 2 years. Look, we've hit our fiscal rules. You get this little game that gets played. All chancellors do this. So she's going to try and avoid that in the future by moving to a 3-year target.
And fuel duty is the standard joke here, isn't it? They always say they're going to put it back up, but of course they never do.
Yeah, we've had fuel duties frozen temporarily for 14 years, but they're budgeting in them to rise in real terms in all future periods, as did Conservative chancellors, and it never happens. And the OBR in their report has some relatively sarcastic commentary saying things like, we cannot rely on these revenues.
Today's episode is brought to you by Raisin UK, the free online savings marketplace with savings accounts from over 40 FSCS-protected banks and building societies. Apply to open as many savings accounts as you like and manage everything under one roof. What's more, you can receive a £100 bonus when you register and fund your first savings account with a minimum of £10,000 using the code SAVINGS100. For more details, please visit the link below or go to raisin.co.uk/PensionCraft.
So going back to the market reaction, we've said, on one hand, it's nowhere near as bad as following Liz Truss's mini budget, but it's also not nothing. Something's happened in markets, and they have repriced UK borrowing costs. Is that a rational reaction? Is what the Chancellor unveiled sufficiently expansionary or costly to mean that government borrowing costs should have gone up by 30 basis points?
I think it's always helpful to place these things in a context of what's the better investment for investors. Now, at the moment, you've still got 4.95% on SONIA. So if you're in a money market fund, you can earn more than the entire gilt yield curve. So gilts are just not attractive for your average investor in the UK, retail investors at least. You can earn more by just plonking it in a money market fund and waiting. So that means that there isn't a level of support, at the moment at least, until the Bank of England starts to lower that short-term rate. Now, was the market reaction rational? It's difficult to say what the market was pricing in. I don't think there's a credit risk premium here. I think what we're talking about is pricing in perhaps higher growth That's certainly one aspect of it at the long end of the curve. So maybe the market was actually believing what was going to happen. Certainly there's a degree of inflation expectations. We saw inflation expectations increase, and that's also priced in at the long end of the curve. That increases yield too. So I think it was a combination of those two. Maybe a bit more inflation than growth expectations. And if you look at the 1 year part of the curve, that's moved up quite a bit because what people now expect is that the Bank of England will have to keep rates higher for longer. And yields rose at the 1 year part of the curve in anticipation of that.
Yeah, I agree with you. I saw a lot of commentary saying, well, this is a negative verdict from markets on the budget. Markets don't like it. I don't think that's true. I think that's a misreading of the situation. I'd see this more as markets just pricing in the cost of the budget. The government's going to borrow more, a lot more, to be frank. And that means probably a little bit higher interest rates and inflation. That has costs for the economy and it has benefits. There's a genuine trade-off there. And so markets go, rates are going to be higher. It's not a bad verdict. It's not saying we're going to go into this death spiral and rates are going to soar to the sky. It's just saying you've made this choice. You're going to go for growth at the expense of a little bit higher inflation and rates. Well, this is what it's going to cost you from the bond market.
And again, if we compare the 1 year yield and compare it with the Kwarteng budget, for the Kwarteng budget, it moved up about 80 basis points, the 1 year yield. And so far, at least for the Reeves budget, it's moved up 49 basis points. So about 5/8 as much. That's a much closer reaction to what we got with the Kwarteng budget. And I think that's based on this expectation of inflation.
If you look at the forecast from the Office for Budget Responsibility, the OBR, they did up their forecast for inflation and interest rates, but not by much. So they said bank rate would be roughly 1/4 of a percentage point higher over the period versus their previous forecast. And they expect inflation to pick up to 2.6% next year. And it's important to stress this is versus the previous forecast, that expectation around bank rate. So it's not that rates are going to go up from here. They still expect the Bank of England to cut. It's just that they'll cut a little bit less or a little bit more slowly. But I don't want to be too complacent. I think this budget does represent a genuine gamble and there are risks here. So the first one we've mentioned is that there is very little headroom against those fiscal targets, the fiscal rules that the Chancellor has set. And in fact, the OBR estimates that there's only a 54% chance that the government will hit its fiscal mandate. So maybe that's one reason that the markets have demanded a higher yield for gilts, is that there's a reasonable chance here, a coin flip maybe, that the government's going to have to come back and borrow more money than they've said.
Because they have committed to certain things which they haven't specified a date for it. Things like increasing defence spending to 2.5% of GDP. That's going to be really tricky to do unless they get considerable growth ahead. They haven't said when they're going to do it. They just said at some future fiscal event, which is pretty vague. But if something like interest rates increase, that increases the debt servicing cost, well, there goes your fiscal headroom. And that's not always under the government's control.
But there's another risk here, which again we kind of touched on, which is the front loading of spending. So if you look at the budget, day-to-day public service funding is set to be almost 5% higher this year than last year. And then they've budgeted for it to grow another 3.1% in real terms next year. But after that, for the last 3 years of the Parliament, they've only budgeted in a rise of 1.3% per year. That seems tough given how threadbare public services have been over the last 10 years. And if that's unrealistic, if they do have to spend more money to stop real terms cuts to some departments, because remember, health spending is going to have to rise by more than that, as is welfare spending probably. So that would mean real terms cuts to a lot of departments. So to avoid that, they'd either need more tax rises, which they haven't talked about, or they need to go to the bond market and sell more bonds.
Yeah, the big gamble here is growth. If they don't get the growth, they're in real trouble because they've assumed they're going to get the growth and it may not materialize. Or at least it might take longer than people expect because a lot of these effects are very long term. If you improve infrastructure, it takes a while for that to feed through into higher GDP growth.
And the OBR is negative on growth. They forecast weak growth for this whole Parliament. There's a little bit of a tick up over the next year or two as some of that front-loaded spending comes into effect. But they don't think this budget has a meaningful impact on UK growth by the end of the 5-year forecast. So the OBR is forecasting that in 2030, at the end of the period, we'll have real terms GDP growth of just 1.6%, which would be disappointing given how much money is being spent here.
Now, I think one of the things which I have issues with is just using one forecast to predict what's going to happen to UK growth. Now, we had a great conversation with Sir David Spiegelhalter, who has done a huge amount to teach people about Bayesian statistics, inference, how statistics works, and how modelling works. And a lot of his work has been combining models and trying to make your inferences better because of that combination of different outlooks. And I think one thing that the government currently doesn't do is any kind of model mixing, combining models, comparing different views to see what could happen in future. And depending on just one forecast, the OBR, I think is a step forward, don't get me wrong, but I think having multiple forecasts would be a better way of doing it.
Yeah, I really enjoyed speaking to David. And the line that sticks in my head from that whole conversation is model combination is more important than model choice, which is exactly what you're saying here. Because the OBR's forecasts are pessimistic. And there are other people forecasting what's going to happen as a result of this budget who are much more optimistic. So the IMF is positive, and they see this budget as sustainably raising revenue with a focus on boosting growth, which is good. And I've seen some research from Carsten Jung at the Institute for Public Policy, who forecast significantly higher growth than the OBR. So I guess the question is, why is the OBR pessimistic, given that the government's ramping up investment so much?
Well, if you listen to what the government says and what the OBR says, the phrase that keeps on popping up from the government is crowding in, whereas everything in the OBR's report is crowding out of private investment. That's a huge difference between what the government says and what the OBR says. The OBR doesn't say crowding in once in their report.
No, I read that OBR report, and the first thing that jumped out to me was that you talk about maybe Reeves could have borrowed more and invested more. That wouldn't have made a difference to the growth forecasts within this parliament. Because their model assumes the economy is near capacity right now, unemployment's low, real wages are rising, and demand is not particularly weak. They basically offset any increase in public investment against private sector activity. So, yeah, Reeves, I don't think, could have made these forecasts look much better by ramping up borrowing even more.
But the thing is, all of these assumptions are based on something called the output gap, which is the difference between current growth, or projected growth if you like, and a rate at which you assume the economy could grow. And basically, if you ask 10 different economists, you'll come up with 12 different answers on what the output gap could be.
If only we had a prize-winning economist to speak to right now.
Steady.
Don't be too modest. You are a prize-winning economist now.
Yeah, because I love economics so much.
Are you going to have to stop slanging economists off?
No. But look, the overall picture, I think, is one of an OBR which is too gloomy, a very strong set of assumptions in their outlook, which is based on this view about the output gap. And I think it would add a lot if we had other forecasters included into the forecast.
Imagine how controversial it'll get, though, if you sort of override the OBR to some degree by mixing in more optimistic models. Whether markets are going to like that, I don't know. I agree from a statistical point of view, it makes sense to have a range of forecasts.
But economics is so subjective that I think if you don't have more than one model, it's very misleading.
But don't you think the clue's in the title, right? Office for Budget Responsibility. That sort of implies they should be a little bit pessimistic, a little bit cautious and conservative, and not let the public finances have too much of a risk of runaway debt.
Yeah, I think that's true. But if you're going to ask Eeyore his opinion on what the budget's going to mean, you want to ask Tigger as well.
I like that. I'd ask Owl.
Owl as well. But not Pooh. I mean, he's just so stupid.
But even if we are only asking Eeyore, I want Eeyore to be competent. And there was a pretty big oversight from the OBR, which did materially affect what Reeves was allowed to do in the budget. So, as we said, she changed the fiscal rules to a kind of looser one, this persnuffle thing. And ahead of the budget, everyone said, if she does this, it's going to buy her a huge amount of headroom, something like 50 to 60 billion pounds of headroom. And everyone was saying, if she spends that all at once, markets are going to freak out. And then we came to the budget and she did change the fiscal rules and there was no headroom left. Did she spend all this money? A crazy amount of money? Well, no, she didn't. And the reason why is because the OBR said, oops, my bad. That 60 billion I said last time was going to be the headroom. It's actually more like 40 billion. Sorry, there's 18 billion missing. And when I say they owned up to it, they sort of squirreled it away in a little footnote at the bottom of one of their pages. It took Bloomberg to point it out, didn't it?
Yeah, that was awful.
But maybe that's one of the reasons why the market reaction was relatively negative, is that they saw the fiscal target had changed and yet there's no headroom left.
Yeah, that was atrocious. And the fact that it was just a footnote, they should have fessed up big time. But I couldn't believe that it wasn't even in headlines after that. But coming back to the mixture of forecasts, I think the other notable one was from Moody's, which was quite pessimistic.
Yeah, I think that added to the worry a little bit, didn't it? Moody's said, in our view, the increase in borrowing, which is in part supported by a new measure of debt under the fiscal framework, will pose an additional challenge for what are already difficult fiscal consolidation prospects. They're basically saying that there is a risk that debt could get out of control here if growth doesn't come.
Yeah, so I'd say that's a bit pigletish and still a bit miserable. Because if you look at what the US has done, and they've got quite a lot of crowding in, moving chip manufacturing back to the US, that's employed lots of people, thousands of people, and I think it's a very positive thing for the US to do. Plus, they've got all of the infrastructure spending, which has also boosted their growth. And a large part of that, if you look at some of the analysis of it, is due to crowding in. So they haven't seen huge amounts of crowding out. They have seen crowding in. So they've created these incentives for companies to invest. That's part of it, but also direct subsidies. So that's what I think has been very effective in the United States. And I think we could replicate that here too. But if you ask the Office for Budget Responsibility, they'll just say, well, it'll take ages to pay off.
Yeah, and when you say ages, really, we do mean ages. So they forecast a 1.4% boost to annual GDP growth. Woohoo, that's pretty damn good, but not really kicking in for almost 50 years. Like the 2070s, they think you'll get up to 1.4% boost. And if you look at the graph, there's a massive error bar around that, which is fair. Like, who knows, right? And I don't want to be too negative on the OBR. I don't think it's out of the question at all that we have weak growth going forward. Like, we've had weak growth for the last 15 years since the financial crisis. To believe it's going to change now, I think comes down to, do you think the government is going to spend that money well?
And just looking at those 7 pillars of growth that Reeves announced, I think, yeah, that sounds quite promising. It's a sort of Keynesian wish list. Any Keynesian will say, yeah, that's the stuff which should fix the growth problem.
I saw that Keir Starmer was asked, well, why is the OBR's growth forecast weak? And he basically said, well, all the reforms we're bringing in are in train but haven't been modelled yet by the OBR. And the big one being planning reform, where Starmer says, and I quote, a big build could become as transformative for working people as the Big Bang was for the City of London in the 1980s.
Plus, I think devolving some of the decisions to local governments, to regional mayors, I think that's a good idea because they've probably got a better idea of how to spend it than central government. So a lot of it, I think, is not tangible, not something you could enter into a model, but I think promising.
There would also be a lot of upside from tax reform and simplification, deregulation of certain industries maybe, and, you know, the big one, which we're never allowed to speak about, closer trade links with the EU would be helpful.
Which they won't go whole hog with, of course, because that would reverse Brexit. But they are taking baby steps in that direction.
But in terms of public investment, I think there's a thinner line between day-to-day spending and investment spending than you might imagine. Labour is obviously going to come under pressure from unions and NIMBYs and lots of other narrow interest groups to direct a little bit of cash their way or to stymie the reforms. They need to find a way of spending that money to boost productivity and to get the private sector to come with them. That's the big challenge. And moreover, they need to find a way to keep the market on side, because although we've been a bit dismissive of bond vigilantes today, they can cause a problem. If your borrowing costs do rise fast, then obviously you're going to breach your fiscal rules because your debt servicing costs will be really high, and you just won't be able to borrow to fix the problems.
Yeah, I mean, look back on the sovereign debt crisis in Europe, and I think the peripheral spreads widening was justified. There was profligate spending, and people didn't care about debt to GDP, but markets did. So I think this error correction mechanism that you get in the bond market is not necessarily a bad one, and I think it's a rational one from the point of view of the bond investors, and it keeps governments in check, which itself is a good thing. But if you do get a dose of bond vigilantes, then the aftermath can be incredibly painful and very long-lasting. I was looking at a graph of unemployment in Greece recently, and it was very high for such a long time. So I think it's difficult to overestimate how much pain, economic pain, Greece has felt as a result of those economic decisions in the early 2010s. So once you do fall foul of them, yeah, you can certainly feel the pain. And this is a very powerful force.
Feels like we've not thought about that force for quite a long time, since the sovereign debt crisis in Europe, probably. Is that because QE, quantitative easing, kind of killed off the bond vigilantes, right? If the central bank is buying bucket loads of the government's debt, well, bond vigilantes don't really have enough firepower to push up yields. But now central banks are selling government debt. We've got QT, the opposite. Does that give more of an opening to a bond vigilante if they believe the government's being too profligate?
I think so, but only if they very rapidly sell. And of course, you're assuming that bond vigilantes exist, and I'm not convinced they do. You've just got boring fund managers sitting on a pile of debt just thinking, oh, am I going to lose more money on these gilts?
I know that you're not a bond vigilante. You're kind of the opposite, right? You were hoping gilt yields rose further so you could buy bonds.
Yeah, I was hoping there was going to be a big sell-off in gilts, but it was very disappointing. It was tiny in magnitude, and it's still not attractive relative to something like a money market fund. So, yeah, I just was very disappointed. I thought this would be an opportunity to fill my boots with gilts, but no.
If the government's looking for a new head of the Bank of England, someone who will institute fiscal repression, Robin is, no, you'll go in and step in. Bye.
But I think that's a natural safety valve. If you reached something like 5%, then yeah, at that point, it becomes really attractive to buy gilts. And that would probably slow the sell-off considerably. Now, you've probably noticed that we've been talking about whether it's worthwhile buying gilts. And a question that crops up a lot at the moment is when it's going to be worthwhile switching from money market funds to gilts. Join that conversation, discuss it with us, and you can do that as part of our membership. To learn more, just go to pensioncraft.com/membership.
Okay, today's dumb question of the week. Does public investment crowd out or crowd in private sector activity? Now, we've said that in terms of modelling the implications of this budget on growth, the key question is whether you believe an increase in spending from the government is going to squash the private sector or actually boost the private sector. What do you reckon?
So let's begin with what crowding out and crowding in is. Perhaps we should have said that earlier. But the idea is that if the government spends a certain amount of money on the economy, the question is, will the private sector also chip in? Or, having seen that the government's spending money on this infrastructure, say, will they stop spending so they'll be crowded out? And there's a big debate about which of those happens. Clearly, the OBR favours the crowding out hypothesis. If you look at the White House and the US, seeing what's happened with their stimulus, yes, it seems as if the private sector has crowded in and spent in infrastructure alongside the government. But it's not a clear-cut thing. But it really boils down to working out whether the economy is running at close to capacity. And that itself depends on something called the output gap.
Yeah, I think it's fair to say there's evidence for both these things. They can both happen. It could be crowding out and there could be crowding in, depending on where we are in the economic cycle and whether there's room in the economy, in effect, for the government to spend more without having to suck resources away from the private sector. So let's take the scenario where the economy is at or near capacity. If the government increases public spending, how does that cause crowding out? Well, one way is it generates higher interest rates, which, as we know, depresses private sector investment. As an aside there, private savings in the economy are more likely to be going into buying government bonds rather than funding private sector investment with higher rates. There's also increased competition from the government for resources, for workers, for raw materials, all this stuff. And therefore, there's less for the private sector to work with. And also, if the government's piling into certain markets, like if they set up a state bank or a state healthcare system, these things might be good, but there's therefore increased competition against private companies in those sectors. So that's the kind of theory of crowding out, those kind of effects working together to mean that the government captures a bigger share of the economy at the expense of the private sector.
Now, the idea with crowding in is that it assumes that there is some kind of output gap. In other words, actual GDP is well below something called potential GDP. What's potential GDP, you wonder? Well, it's something which is estimated by economists based on historic rates of growth. You might also look at things like capital stock, how much of existing capacity is utilised. You could look at the labour force, you could look at wage growth. All of these things would factor into this measurement of potential output, but it is a very difficult thing to estimate, and there won't be agreement on what the actual number is. So that's why I think anchoring your expectations about growth on an imaginary number is difficult and problematic, and you need more than one model to estimate it.
But let's assume that there is an output gap and the economy is running below capacity. Maybe we're in a recession or a period of very weak growth. What's this crowding in then?
So the idea here is that companies will not be operating at full capacity, and that there will be people in the labour force who they can employ to increase their output. And that means that the stimulus will have a bigger multiplier effect, if you like. So every pound or dollar that the government spends will have a bigger effect on growth.
So that's the idea around a kind of macro stimulus. There's more money in consumers' pockets, and in a period of weak demand, that's good. It's not going to lead to very high inflation. And the other side of the coin, I guess, is that if the government spends on building better infrastructure, things like roads, energy infrastructure, broadband, all this stuff, then that can improve productivity and make businesses more efficient, effectively, and can help grow the economy.
And there's also an element of confidence here. So if you do get the government spending, that can improve business confidence and consumer confidence, and that makes businesses and consumers spend more. That's a little bit more of a psychological, animal spirity type argument.
But I guess the question of will you get crowding out or crowding in, if we believe it comes down to this assessment of the economy and whether there is spare capacity, whether there is slack in the economy, that is a judgment call that is very hard to make. It's interesting that the OBR's model, when you look at real wage growth, is forecasting it to be very poor still. They said the last parliament was basically the worst real wage growth on record. They think this parliament is going to be the second worst, so just marginally better. We'll see, I guess. I mean, let's hope the OBR's wrong in that, but I don't want to be too harsh on them. Like, who knows? Economics is not an exact science.
But I think the wrong response to uncertainty is to do nothing. And that simply wouldn't have been acceptable. And things, I think, probably would have got worse in terms of infrastructure in the UK. And if you live here, you realise how bad things are.
Even if it all goes wrong, at least we'll have a fast way to get to Crewe. Thank you for joining us for Many Happy Returns. Do send us your questions, no matter how dumb, at the email address mhr@pensioncraft.com.
And do remember to check out PensionCraft.com for all the information about our membership and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Roman Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.